Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Friday, and it's happy Friday to you guys. I hope you guys have great upcoming plans for the weekend as we are in summer. Hey, we got kind of a light news day today, so this will be kind of quick and sweet for you guys. Today we just got two items on the economic calendar brought by the market PMI Flash, and it's presenting its manufacturing and non-manufacturing, or also known as services. So let's start with the manufacturing for the month of June. So previous report came in at 56.4. It dipped down to 54.6. And then non-manufacturing services dipped from 56.8 to 56.5. So on both of these indexes, anything above 50 is considered expansion or optimism. So just kind of give you a gauge where we're at. Now, manufacturing, we may kind of see that here with the announcement of these tariffs coming in with China and Europe, that you may see a pullback in manufacturing. So as we saw the last time, about 2 months ago, there was a bit of a pullback when these were initially first announced, and then we saw that yesterday's numbers that came in with the Philly Fed that came in, and how much of a drop that came in. So let's take a look here ahead at the headline news. Stock market is mixed. The difference this time is typically the Dow's been the one that's been down, whereas everyone else been kind of in a rebound or in a positive territory. But this time it's as actually Nasdaq that's in the negative territory. Now, essentially, there's still concerns and worries over the tariffs as we're starting to get into it with Europe again. As Europe announced their tariffs to be implemented, as well as we've talked about our tariffs we're going to implement against Europe. And of course, we've already talked earlier about last week with China, so it's kind of we're getting this kind of a global scale level as we're the largest economy out there, but we're at that point where we're kind of at that where we're not really going to be growing much. So if anything, we're at that kind of, we've already peaked, so to speak, with our growth in the economy. So that's the concern for a lot of the investors out there. Now, let's kind of move ahead here to see how the bond market is reacting. Bond market is in a positive territory right now. It's been kind of going between this +2 to -3. We've been kind of just above this 50-day moving average. We got 25-day moving average and 50-day moving average ready to cross here. So this is obviously positive. So if we can, because usually when you get this, it gets squeezed to one direction or other. Right now it's looking on the positive side, but we never know. All right. So we did have that negative cross. They had that crossover that could put us into that kind of reversed it. So, but this could be a knee-jerk reaction here. But it'll take its cue from stocks. So that's something we want to watch throughout the day here is stocks, to see if the stocks continue to rise in positive territory or if it might be a knee-jerk reaction and lose its gains late in the day. So again, you guys might want to follow me at Twitter, and I'll post those out later on today. Treasuries, again, we're kind of at the 100-day moving average. We're at 2.9 right now on the yields. So we're kind of at the lower end here. It's trying to stay above this 100-day moving average, but if it breaks below it, that would obviously help out mortgage-backed securities, as mortgage-backed securities will only increase and improve interest rates as we move forward. Now, concern that you may or may not be aware of, the Fed is trying to reduce its balance sheet of mortgage-backed securities and treasuries, so that extra supply out there is there's not enough demand for that supply. So it's worsening our interest rate. So every time they've done that, each quarter they're reducing it. So we had they're buying 30 billion, reinvesting it back in the first quarter. Second quarter went down to 20, and now we're going into the third quarter, and they're reducing it down to $10 billion. So with that $10 billion, basically, again, those April and also in January we had worse in our pricing. So just be careful coming into July that you don't get stuck with we get a big jump in pricing in our interest rates, a bit of a spike in interest rates here. And that's what mostly what it's from is the Fed reducing their portfolio. So that's pretty much it. So again, as we talked about, want to keep an eye on that stock market, see where stock market heads, to see if interest rates continue rising, if they continue to show some improvement, or if they're going to give a knee-jerk reaction and go the opposite direction. So just follow me at Mike Bjork here. Hope you guys enjoy the rest of your day and enjoy your weekend. We'll look forward to see you guys on Monday. Thanks so much for watching. Bye-bye.